Let's talk about a trade that went wrong, aka my put that I sold in Rocket right before the last earnings, and then the stock proceeded to tank around 30-35%. The good news is after rolling it to a further expiration date as well as a lower strike, we finally made all that money back. And in this video, we're going to go over kind of how I defended the short put that got breached and some takeaways. I'll start off by saying Rocket is one of my favorite positions to trade around in the options portfolio, as most of my strategies are around theta decay. And if you look at the chart of Rocket over the past year, it tends to trade sideways or explode in price and then kind of, trade sideways slightly down. Over an entire year, this stock is pretty much traded flat, which for a stock that trades pretty much at an average around 20 to 24 bucks over the past year, it also has higher implied volatility. So when I'm selling options in this stock, I am getting paid a little bit more than if I'm selling it in a blue chip company. Let's dive into the trade that actually went against me though. On May 5th, I closed a Rocket position for a 50% win. I tend to sell a lot of puts in Rocket, so I had sold this for $150 and closed it for 75, so pocketed 75 bucks on that trade. Now here is where I made the mistake. Unfortunately, at the time, the VIX and the overall market had lower volatility, so I was hunting for positions that I could put on. And I remember thinking to myself, well, I can just sell another put in Rocket even though there's earnings, as it has slightly elevated IVR and there's not really any other plays out there. So I definitely forced myself into this position with not the best setup, knowing that I was also going into earnings that night. Now, if I can, I try to avoid trading around earnings, as it's more of a binary event and I feel like I have less predictability when it comes to predicting short-term moves. But on that time, or in that time frame, my portfolio was pretty light on theta decay, and I was looking for something to put on. You can probably guess what happened, but on May 5th, you can see the price was around $22.80, and the next day it had fallen to $19. And I had sold the $20.89 put for $124, so instantly it was being tested, and over the next couple days it continued to crash, and Rocket was sitting around $16.58. So what do you do in that situation where a stock goes against you a lot, especially when you sell put? I think the most important thing is, for when I'm selling puts, I'm looking at the underlying business that I'm selling puts in. So I'm not just looking at a ticker symbol, just at IV. I'm looking at Rocket Mortgage, and I still believed after the earnings that came out that the company was still at least worth $20, $21 for fair value, because the stock itself for the company, their profits versus their valuation is very low. Their PE ratio is ridiculously low, but it's a cyclical stock, and loans were basically flying around in 2020. Real estate was hot, so a lot of refinancing with low interest rates. The market is expecting higher interest rates, which will hurt the refinance business. But for me, the valuation multiple is so low that even if the revenue comes down, I think trading around this level still makes sense, even for a cyclical stock. How do we defend this? Well, after it crashed to around the 16.58 area and broke that 17 handle, I was thinking about, well, do I roll the position now to a lower strike price and take a loss, or do I sit on it? For me, in these situations, because I couldn't roll it for credit and I thought the valuation would still come back to around that $20 level, eventually I just held onto the put, ready to take assignment. At the end of the day, I'm trying to avoid the assignment if I can. So the idea was, if we did get any type of rally, I could roll it out further in time and give the initial trade, more time. Luckily, we kind of caught a relief rally. Maybe it was just a little luck of the Irish, and we kind of filled the gap with the whole explosion in meme stocks again. We had kind of short squeezes going on. In that, I sold another put. I basically rolled the position and to a lower strike as well as further out in time. And that's exactly what I did on June 2nd, where I rolled the position further out in time and actually lowered the strike price on the new put that I sold. So I bought back the June 18th and then sold a new July 16th 20 strike put. I did this all for a credit. So all in, we're basically sitting at a $1.25 credit. And then you can see on the 29th, yesterday, I was able to close that original put for 63 cents. We collected $125, bought it back for 63, profit of 62, and one of those situations where we battled it for a couple months, but we came out ahead. Now, that profit may not seem like a lot, but we did have a larger loss in the position initially. I think we got down to a loss of around $300 to $350. So coming back from a $350 loss to around a $62 win, that's a $400 swing in the portfolio. And since the portfolio is around $11,000 to $12,000, that's a bigger chunk of the portfolio. It's not a massive options portfolio. Let's talk about some of the key takeaways from this trade, as that's always important to go over. For me, it was not forcing trades that don't have optimal setups. So the IVR wasn't over 30, but I was kind of forcing myself to get into the position to add theta decay to the overall portfolio. Secondly, earnings. It's a binary event where, yes, you can make quick money, but then the trades can also obviously go against you pretty quickly as the implied volatility is increased. And I don't know, for me, I'd rather trade around a predictable range where there isn't a binary event instead of trading around the actual earnings themselves. Third would be having an understanding of what you think the business is worth intrinsically helps a lot. I think combining that fundamental analysis and technical analysis keeps you calm when the trade goes against you and goes through the short put, as you are confident that the stock could come back to that price eventually. So you can continue to roll out your puts, collect more premium, and basically wait until the stock rallies back to what you think is more of intrinsic value. Fourth would be, it's okay to take losses if the thesis on the original trade changed. So I saw Q1 earnings. Nothing changed for me in my mind because the earnings seemed great. I didn't think the earnings power of the company was going to deteriorate instantly because I didn't think interest rates were going to spike up all of a sudden with the Fed policy. So I just left on the trade. If something does change or material news comes out and you believe, it's no longer worth $20 per share, then that's where you should just cut your losses and take the L. Also, another way to frame it is, if you didn't have a position on, would you put on a new position? For me, I would have loved to sell put after the crash in earnings because I didn't think they were that bad. But yeah, that's kind of giving you the thought processes that I had throughout the trade and some of the reasoning behind either rolling out, waiting for the stock to rally, and you can maybe have some takeaways yourself. Let me know in the comments if you did like this kind of video where I go over a previous trade and talk about some of the takeaways or key learnings. Also, if you did enjoy the video, give it a thumbs up and consider subscribing to Mainstream Wolf, where we talk options, investing, personal finance, anything to do with money. Thanks guys for watching, and have a great day.